So if you've been thinking about purchasing an Indexed Universal Life policy or an IUL for tax-free retirement purposes, there's four things you're going to want to look out for when setting up your policy. The very first thing you want to do is make sure you have a max funded minimum death benefit policy. And what this means is you are setting up the policy based off of the most you want to put into the policy. So let's say you want to put $1,000 per month into the policy. That's what you're going to put in, but then the minimum is probably only going to be $100. So what you're doing is you're minimizing the cost of insurance for the contribution that you want to put in of $1,000. What this is going to do is allow you for the most cash accumulation. That way you have the most out of your policy as far as growth that you can possibly get for retirement and everything like that. The second thing you want to be sure of is that you're not paying fees to set the policy up. Any agent that says there's fees to set the policy up is just charging fees. Like, there is no fees to set up a policy. Some agents will charge you to set this up when they don't have to. And then some agents, this is part of number three. I'll just put that in number three. So number two, there's no fees to start up one of these policies. If you're approved, you're approved. And your premium contribution that you agreed upon, that's what you pay. Let's talk about that third thing I was about to say is you do not want to lump sum the policy for most cases. It's possible to do this, but most cases you will never want to lump sum a policy. Let's say you have $100,000. You won't want to dump it in on the first year and then put $1,000 per month in after that, because what you're doing is the agent is selling you a policy to accommodate that $100,000. So they're selling you a lot more insurance and they're making a really high commission. So a lot of agents will say, hey, you need $5,000 or $10,000 to set this up. That's not true. They're doing that to make more money on the front end. You never want to lump sum a policy unless it's a level death benefit and you're like 60 and you're doing something very strategically following TEFRA and DEFRA. And there's a whole different story, but most people aren't doing that. So never lump sum a policy unless there's a very specific strategy to doing so. And number four, you want to ensure that the policy is a non-MEC. It is not a modified endowment contract. This will be stated somewhere in the illustration. Your agents should also talk about that. A modified endowment contract is when you fund the policy too much, you violate all of the tax codes, 101, 72E, all of the good things, 7702. If you violate TEFRA and DEFRA, which constrain the amount of money that you can put into a policy in a 5-year window, if you violate those tax codes, you will be responsible for the taxes that come with these policies, and you aren't supposed to have to pay taxes. These are well designed, if designed properly, to be a tax-free retirement account and a tax-free cash cow for you. So you never want to have a modified endowment contract. If you create one, that's just silly. So ensure that you do not, or your agent does not, create a modified endowment contract. So those are our four biggest key points when setting up your IUL. If you want one, you know what to do.